Good afternoon, everyone. I'm Tejas Vaiti from Kirin Advisors. Welcome to the virtual roadshow of Strider's Impex Limited. Today, we will provide a brief overview of the company and its innovative business model. Strider's Impex Limited is a consumer products company engaged in the licensing, development, sourcing, and distribution of toys and kids' consumer merchandise. Its portfolio includes own brands such as Pugs at Play, Furry Pulse, Girlies, Minds at Play, and SHDZ, which have already been launched in the market. It has also registered Fanster, BZ Kids, and Bauji, which are slated for upcoming launches in multiple categories. So, from the management team, we have with us Mr. Kumar Shri Baheti, Managing Director and founder of the company. Good afternoon, sir. Welcome.
Good afternoon, Tejas. Thank you so much.
We also have Mr. Mustafa Kapasi, Managing Director and founder of the company. Good afternoon, sir. Welcome.
Good afternoon, Tejas.
From Capital Square Advisors Private Limited, we have Mr. Ashwin, Executive. Good afternoon. Welcome.
Good afternoon, Tejas.
Now we'll play a short AV of the company.
At Strider's Impex Limited, we believe every child deserves products that spark imagination, creativity, and joy. Our purpose is simple: to create meaningful experiences through thoughtfully designed toys and kids' merchandise that inspire learning and play. Founded in 2021, Strider's Impex Limited is a consumer products company engaged in the licensing, development, sourcing, and distribution of toys and children's consumer merchandise. We operate through an asset-light and scalable business model, combining globally licensed brands with a growing portfolio of proprietary in-house brands. From concept to creation, Striders delivers end-to-end capabilities: product design, development, sourcing, manufacturing coordination, and multi-channel distribution. Our product portfolio spans plush toys, mechanical plush, activity sets, back-to-school products, bags, kids' luggage, and lifestyle accessories, catering to children from early years through adolescence. Strider's strength lies in its balanced brand strategy. We work with globally recognized licensed characters that enable faster consumer connect and strong recall, while simultaneously building long-term brand equity through our own proprietary brands such as Pugs at Play, Furry Pals, Girlies, Minds at Play, and more. The company holds registered trademarks in jurisdictions outside India, including the United States, China, the European Union, and the United Kingdom. Manufacturing is strategically outsourced to trusted partners in India and China, ensuring quality, scalability, and supply chain efficiency. Our products reach consumers through a strong multi-channel distribution network across modern trade, general trade, and leading e-commerce and quick commerce platforms. Supported by a growing international presence through our UAE subsidiary. Over the years, Striders has steadily expanded its footprint, strengthening retail partnerships, entering new categories, participating in global industry forums, and scaling its proprietary brand portfolio across domestic and international markets. Striders Impex Limited is led by its founders and managing directors, Mr. Kumar Shri Rajkumar Baheti and Mr. Mustafa Ismail Kapasi, who bring decades of combined experience in retail, licensing, merchandising, distribution, and brand building. They are supported by a seasoned leadership team focused on operational excellence, innovation, and sustainable growth. With a clear vision, a robust brand portfolio, and a scalable operating model, Striders Impex Limited continues to create products that resonate with children and parents alike. Striders Impex Limited, where imagination meets innovation and play creates possibilities.
With that, now I hand over to Kumar sir to tell us the journey about the company. Over to you, sir.
Thank you. Thank you, Tejas. I think somebody will need to share the presentation so that I can take people through the presentation. Thank you so much, everyone, for coming and spending time here with us. Today, we'll just take you through, the entire journey as to how we started, what all we do, what is the business model, and what has been the journey till date. from our side. So just to give you a brief about Striders. So Striders is a consumer products and company basically which is dealing in the licensing, development, sourcing, and distribution of toys and kids merchandise across different categories. So we are a very asset-light model. We don't own factories, and we play into the licensing play where we take licenses from the licensors as well as we develop our own IPs. Uh, so that's what normally we do. That's the overview about our company and the basic business structure what we have. How Striders stands apart is basically it provides end-to-end solutions in whatever categories it enters, be it girlies where we have girl the toys which are related to girls, be it back to school where we are extensively present and provide an entire end-to-end solution, etc. So we basically distribute all of these lines across different channels of distribution, including key retail, including general trade, e-commerce, as well as quick commerce. So between myself and Mustafa, when we started off this company, we always had a vision, to start off this company in such a way that we are able to obviously aspire to go global. We wanted to start a company and create a product line which is globally acceptable as well. That's when we started off Striders. Both myself and Mustafa come back with the same background, toys and consumer products, since many years. Almost 2 decades each is what we have an experience of in this industry. I come back from a corporate background where I've worked with the likes of Stephen Barry's Future Group, Reliance Retail, where I was heading the buying and planning for Hamleys, and then moved to Landmark Leisure in Middle East to head their buying and planning. So my journey has been entirely into sourcing and product development throughout multiple years. And before, obviously, I ventured into entrepreneurship. I spent all my 16, 17 years into corporate life. Again, company was incorporated in 2021. We currently have operational presence in India and UAE. Currently, we have 9 proprietary brands across multiple categories. We have 10 registered trademarks across India as well as overseas, and we have 5 trademark protection, particularly in India, US, China, EU, and UK. Our TG is basically from 18 months to 15 years across different categories. So this is about us. In terms of FY25 consolidated financials, we were at 61.86 CR, EBITDA of 15.07%, PAT of 13.59%, which is 8.4 CR, and return on capital employed of 58.67%. Moving on to the next slide. Again, that's been a growth journey. We started off, in India in 2021 when toys was banned to be imported into India. We launched in India with our own IP, Pugs at Play, in 2022, where we started developing this whole line during COVID and came up with a concept around animals into mechanical plush. We launched this with Hamleys, and we also commenced our institutional billing to family entertainment centers. My background also is into family entertainment centers, and we also started developing curated ranges for all the FECs. In 2023, again, we expanded the product portfolio to back to school category. Mustafa comes back with a very, very strong experience of back to school. And in his previous company, we were doing very good numbers in back to school. And that's why we thought that we should be entering this category in the kids space and taking this market share as well. Again, we both aspire to take this company global. And that's how we started participating in global toy fairs like the New York Toy Fair in 2023 with our own brand Pugs at Play. In 2024, we also started participating in Nuremberg Toy Fair, which is called the Mecca of Toys, with our own brands, just to expand the global distribution opportunities for our brand. We also entered into a 3-year licensing agreement with Disney for their plush category in 2024. In 2025, we had 2 companies, Striders Distribution and Striders FZ LLC, which we took over March of 27, 2025, and made it a 100% owned subsidiary of Striders Impex Limited. Striders FZ LLC is basically a Middle East based company where all our global orders will be executed from. The next slide. I've spoken about myself and my background. I would let Mustafa speak about himself as well.
Thanks, Kumar. So I think, like Kumar rightly mentioned, his entire experience has been on the corporate side of things. My entire experience has been on the entrepreneurial side of things. So my journey in toys, licensing, and consumer product started in 2008. So after completing my master's from US, I joined my family business, Excel, which at that point of time was a leading home entertainment distribution company in India. So during that year, we had just recently started a toy vertical under the name MyBabyXL. So I was given the responsibility to lead and grow that part of the business. So during my last 17, 18 years of leading MyBabyXL, I was responsible in terms of forming a core team across different functions of business, which would help me scale the business. Again, identifying the right product categories along with identifying the right sourcing partner who would help us manufacture those product ranges was also a critical part of my overall work profile. Again, acquiring and establishing key licensing relationships was critical to our overall product licensing strategy. And also, I think I have worked along with my team to build different channels of distribution for each of the product ranges. So, like Kumar rightly mentioned, he was a buyer at Hamleys and I was a seller, and that's how we met. And I think we have been friends all this while.
Thank you. Next one. Yeah, so this is our board basically. Myself and Mustafa are the managing directors of the company. Maria Mustafa Kapasi, the non-executive director. We also have two very strong independent directors, Pradeep Chechani and Prasad Menon. Both come back with a very strong retail and global experiences and have been guiding us well throughout. Again, in the KMPs, we have Shweta as a CS, Pankaj Pradhan as a CFO, Malik heads our national sales, which is the GT side of the business. Huzefa takes care of the finance. Manish, we have hired recently from Flipkart to take care of the e-commerce side of the business. Mohammed takes care of key retail, which is the basically the organized retail side of the distribution, and Vishnu takes care of operations. Yes, Mustafa.
Yeah, in terms of business model, I think Kumar mentioned early in his presentation that we have an asset light model where we don't own any manufacturing facility. We manufacture all our products to third party manufacturing setups. Again, this gives us a lot of flexibility to evaluate more sourcing options at the same time enabling us to avoid the high capex cost which is usually associated with factory setups. Again, in our business, we have a fine blend between the license portfolio and our own IP portfolio. Coming back to license portfolio, we represent almost all the major kids international licensing studios in India across four broad categories. The first category is back to school, which consists of products such as school bags, water bottle, lunch boxes, stationery range. The second category is plush toys. The third category is role play and outdoor toys, which includes products like kitchen sets, beauty sets, doctor sets, and outdoor toys like two-wheel, three-wheel scooters. You have footballs, etc. And the fourth category is accessories, which includes products such as sunglasses, watches, keychains, fridge magnets, luggage tags, etc. So if you see, licensing, having a strong licensing portfolio really benefits us because it helps us to open the retail doors easily. Also, at the same time, we leverage our license portfolio in order to, push our own IPs into the same channel of distribution. Again, I'll just quickly give you a summary in terms of how the licensing business usually works. So whenever you want to enter any new category, you usually submit a business plan to the respective studio. Once the studio approves the plan, that's when you get into the contract stage where a minimum guarantee and a certain royalty percentage is finalized. Once the agreement is signed, then the licensor usually releases the style guides to us. That's when the entire product development process starts. We have our own in-house design and product development team, which usually identifies the product, and the designing team does the designing of each of the ranges as per the brand guidelines. After the designs are made, they are usually submitted to the licensors for approval. Once the licensor approves the designs, that's when we get into the sampling stage. It usually takes 2 to 3 weeks for the factories to make the samples. After making the samples, they send it to us. We in turn submit it to the licensor for the final feedback and approval. Once the licensor gives us a feedback on the samples and has approved the samples, that's when we get into the mass production. Once the mass production is done and the goods reach the warehouse, that's when the entire distribution process starts. So again, Striders has a multi-channel distribution strategy. where we have three channels of distribution. So the first channel is your large format stores, where we supply all the stocks directly to them. The second format is general trade, which are your small Kinara format stores. So we have a sub-distribution network of more than 75 plus sub-distributors, where we reach more than 2,000 plus retail footprints in the country. The third channel of distribution for us is e-commerce and quick commerce platforms. So we supply to all the major e-commerce and quick commerce players in the country. Again, like any other business, here also 80-20 rule applies. 80% of the business comes from 20% of our customers. But I think going forward, with us starting our Middle East operations directly, and with us, also expanding our global presence, the pool of customers, we'll have a larger pool of customers. So the concentration risk will be reduced drastically and will not be confined to only select customers here. Also, if you see here, since Striders is very well distributed across all the three channels of distribution, it allows us to have maximum visibility and reach for all our brands, and also it reduces our dependency on one particular channel of distribution. Tejas, if you can go to the next slide. Again, I spoke to you about the license portfolio. I'll quickly give you a summary of the own IPs also, which we own. So again, to start with, I'll start with a master brand, Pugzet Play, which is into the preschool category in the mechanical plush side of the business. Again, here we have tried to create an entire ecosystem around animals. Currently, Pugzet Play is well distributed in more than 20 plus countries. Furry Pals is again an IP which we have created in the non-mechanical plush category. It includes a curated range of cute-looking animals like cats, dogs, rabbits, unicorns, and quirky plushes. We have launched the brand in India and Middle East. Minds at Play is again a board game brand which we had created for one of the supermarket chain in Middle East. Busy Kids is into learning activity sets, and we are yet to launch the brand globally. Girlies is a brand which we had created in the girl space. Again, the brand was created from an intent of providing an end-to-end solution in the girl category. It includes product ranges such as activity sets, plush journals, makeup sets, and accessory portfolio. The brand is very well distributed in India and Middle East. Shades is a sunglasses brand which we had developed for one of the retail customer in Middle East. Fanster is a brand which we just launched last month. Again, it includes product ranges such as keychains, luggage tags, fridge magnets, caps. Here, what we have tried to do is that we have taken an entire portfolio of known licensed brands, and we have tried to create an entire ecosystem around fan merchandise. Boogies is again a brand which is currently under development and will be targeting older kids in the back to school space. So again, having a fine blend between licensed portfolio and our own IPs uh, helps us to command a great position at retail, and also helps us to improve our overall brand value by building our own IPs in this process. Can you go to the next slide? In terms of our overall product and category mix, Pugzet Play, which is our own brand, contributes close to 21.83%. Then you have Furry Pals and Girlies, which is again our own IPs, which have a contribution of 8%. Again, within the back to school space, we have school bags, which contribute 34.79%. And back to school products like lunch boxes, water bottles contribute 16.5%. So if you see, we have a very diversified portfolio of different product categories, which makes us a one-stop solution to all the major retailers in the country. Can you go to the next slide? Yeah, I think Kumar probably
I think it's from here. Yeah. So I think I'll just take you through, what a business development strategy is particularly. So yeah, I think we will be focusing on omni-channel marketing across digital and offline platforms. We will continue doing that. Again, focus on our own brand visibility will be the key, particularly Pugzet Play, which is our master brand, and we are creating a complete brand identity around it. That will be one of our major focus areas. Again, digital presence via our own website, social media, and product content is something what we are looking at very seriously. On ground visibility in terms of putting the products on demonstration, etc. On a global basis, we have put that act on play now currently, and will be focusing on that very diligently, particularly in Middle East and India. In India, it's already been done with major retail stores, Now, since we'll be going direct in Middle East, the same will be happening in there as well. In terms of the initiatives, since our plan is already to go global, we have already started participating in global toy fairs with our own brands, which is Pugs at Play, which is Girlies, which is now been called BU, and also some of the other brands, what we are taking, licensing brands, which we are taking on board for the global markets. So we'll continue doing that. In fact, we are also expanding our presence into tier 2, tier 3 cities as well, to strengthen our distribution down in the Indian market. Again, in Middle East, particularly, we have already formed a subsidiary called Strider's Hub, which will be focusing on direct distribution to retailers and distributors in the region. Earlier, we were working on a model where we used to supply to the distributors and then they used to supply to the retailers. But obviously, we knew that with full focus, when we put it on our brands and we'll create our own distribution channel, that will help us obviously grow sales and generate stronger bottom line by going direct. So we have already formed a company called Striders Hub and will be going direct to the retailers and distributors across Middle East region. That's again a regional focus what we'll be doing. Again, in terms of global region focus, we have already focused on participating in global toy fairs, and we already have team onboarded who's taking care of the global sales strategy to push our brands across different distribution points across the globe. Next. Again, yes, these are some of our key business trends. We are asset light model. We don't own any factories. By both myself and Mustafa, are product development guys. Basically, we both come from that background where we know, the kind of factories, the kind of products, the kind of market gaps which needs to be closed, and we'll continue developing products with an asset light model, without being capex heavy. Again, strong licensing partnerships. Mustafa comes back with a very strong licensing experience, and that is really helping us acquire multiple global licenses in India as well as abroad. We are strengthening our brand identity with our own IPs, and we are pushing across our own IPs to multiple distribution channels, which will help us, strengthen our proprietary equity, our own brand identity. Again, we have already taken you through about what we are doing in India as well as international presence. With two subsidiaries now in place globally as well, we are well poised to distribute, in multiple points on a global channel. Again, we have strong institutional relationships. Both of us come from the same distribution as well as retail background. So between us, we have strong connections within retail, particularly in India and Middle East, which is helping us forge good relationships and enter these retail categories, very efficiently and effortlessly. Diversified revenue base, we are not dependent on one category, nor are we dependent on one licensor, nor are we dependent on one country for our sourcing. So we have a diversified revenue base across different categories, which is helping us to reduce the concentration of risk in the business. Again, we have a balanced portfolio between licensed and own brands. So we don't even have complete dependency on the licensed products. At the same time, the licensed products are helping our own brands as well to gain entry into retail. We have a big dual country supply chain advantage. Both of us come back with a strong sourcing background. We have our factories identified in China, India, where we can work from. And depending on the kind of leverage what we want to take, either from China or India, we choose the factories and supply to our global customers and Indian customers according to the need and the pricing requirements. Next. Again, that's the SWOT strengths we have already spoken about. Weakness, yes, we are dependent on external manufacturers, but here again, that is a deliberate thing. What we are currently doing by not investing in capex is because we have a good flexibility in terms of choosing manufacturers. We have a good supplier base in China and India, and to scale up capacities, we know whom to approach to when the time comes. Again, between India and Middle East, it's a working capital heavy business. Wherever we are distributing, the fund flow will be required. But at the same time, we know that our strength, lies in terms of direct distribution. We can earn healthy margin, and as well as add to the value of the company. Again, we have multiple brands across different portfolios, which requires focus. We are already aligning teams to focus on these brands so that there's complete focus on each and every product what we do. We are strengthening our middle management team as well parallelly. In terms of opportunities, yes, we are expanding our proprietary IPs as discussed earlier. We will also be looking at developing content around our master IP, Pugs at Play, which will help kids emotionally connect with the brand and take the brand to newer heights. Again, we are not currently, too strong into direct to commerce where we are directly selling to customers. So we have already hired Manish on board, who's looking into this and will be starting a direct to consumer channel as well in terms of selling directly to consumers. Again, we are in limited categories currently. Once funds comes in, this will be deployed to obviously in the working capital where we'll be expanding into multiple product categories to increase our wallet share. Again, threats, yes, licensing renewals are time bound and we need to renew it periodically to have that continuity. Competition always exists in all kind of industries and we too face competition from parallel imports as well as imported products. We are present in multiple countries, so yes, we have to take care of the proper regulatory compliances and IP related risks. And again, exposure to foreign exchange. Since in India we also import some of the lines like bags, etc., we are also exposed to foreign exchange movements. Next. Again, that's the whole market overview between India and Middle East first. So India is a big market worth 7 billion US dollars. That's the toy market currently in India. Yes, most of it currently is into the unorganized segment, but the good part is with the growing middle class and upper middle class, people are moving towards more branded toys, more quality toys, and this share from unorganized to organized will keep on shifting. And also with modern retail expanding, like quick commerce, more retail chains, etc., the share will only expand, and we will keep our focus, very tightly on the Indian market. Again, in the GCC, the market is at 1.8 billion US dollars. The market looks small, but again, it's completely organized. It's easy to distribute. There are rich customers in GCC who pay. So we are estimating that, by taking this opportunity to go direct into GCC, this will definitely help us add value in the current company. The next one. That's the global toy market. If you see, compared to GCC in India, there's a huge market out there on the global side. Currently, when we are participating in the global toy fairs with our own brands, we are very confident that with the current team, what we are obviously deploying there, we will be able to capture, multiple distribution points for our own brands globally as well. So we have not even scratched the surface if you talk about the global toy market, and we are on to, doing that. And that's when we saw the opportunity and decided that we should, take our brands global. Next. Again, I think I'll leave this to Ashwin. Ashwin, can you explain that?
Yes, sir. Thank you so much, sir. So moving ahead, here is a peer comparison that we have compared Striders Impulse Limited to OK Play. So our face value is 10 and the OK Play face value is 1. Current market price for Striders was 5.49 and we are yet to be listed, and the EPS is 6.25, whereas the peer is currently reporting negative earnings. Our return on network stands at 56.51%, reflecting strong capital efficiency, whereas the compared to the negative returns of the peer. And during the DRHP stage, KV Toys was not listed. However, we can also draw comparisons with KV Toys to provide additional industry inputs. Next slide, please. So here is the key financial highlights. So as we see, the total income has been consistently increasing year on year. The total income increased from 29 crores in FY23 to 61.95 crores in FY25, reflecting strong business expansion. And in December 2000, 25, the total income was 49.61 crores. The EBITDA has also seen to be increasing year on year. The EBITDA has grown from 3.09 crores in FY23 to 9.32 crores in FY25, with margins improving from 10.32% to 15.07%, indicating better operational efficiency. Similarly, the PAT is also increasing on year basis from 2 crore uh, in FY23 to 8.4 crores in FY25, with PAT margin improving from 6.78% to 13.59%. Overall, the trend reflects strong revenue growth, margin expansion, and disciplined cost management. Next slide, please. So here are some of the key ratios. So as we can see, the ROCE remains robust, standing at 58.61% in the in FY25, and in December 2025, the ROCE is around 25.98%. The company is enjoying a good debt to equity ratio of around 0.97, and the current ratio for the company is 1.50 as of December 2025. While the receivables turnover has moderated over the years, it remains aligned with the business scale and working capital cycle. Overall, the ratios indicate strong returns, reduce leverages, and improving financial stability. Next slide, please. This is a snapshot of profit and loss statement. And this is the balance sheet of the company. As the promoters of the company have already explained this, so here is the investment rationale. The company's investment rationale is driven by a scalable, asset-light, and capital-efficient model built on outsourcing, manufacturing, and license-led strategy, with the balanced mix of global licensed IPs and 9+ in-house brands. The company is also has a strong revenue growth, improving EBITDA and PAT margins, which uh, which provides a good growth story ahead. The company has a pan-India network, leading retail and industrial partnership, and growing international presence through their UAE subsidiary, backed by trend-led innovation, faster go-to-market deliverables, and promoter-led management. Were well positioned to suitable, profitable growth story ahead. Next slide. So here is the issue highlights. The total issue comprises of 50 lakhs 40,000 equity shares, including fresh issue of 45 lakhs 31,200 equity shares, and offer for sale is around 5 lakh 8,800, aggregating to approximately 36.28 crores at the upper bandwidth of 72 rupees per share. The IPO price band is 71 to 72 per share, and the IPO lot size is 1,600 equity shares. The issue is open from February 2026 to and closes on March 2, 2026. Object of the issue: the total the total fundraising will be around 134. Sorry, the total issue is around 36 crores, and in that, the major portion is going to the working capital requirement in India, that is 10 crores, and 4.5 crores will be uh, used for the investment purpose in the holding subsidiary for its working capital, that is Strider FZ LLC, and 6.5 crores will be utilized for the UAE mainland company, and 3 crores will be repaid for the loans, and rest is general corporate purpose. Next, please. Thank you all.
Thank you.
Thank you,
We'll
everyone.
start with
Great
Q&A
questions.
session. I
Yes.
request all participants to post your questions in the comment box. So we have our first question from Mr. Arab. What role do your subsidiaries play in the overall business strategy?
I think subsidiaries will be playing a very important role, Arav, for us. So we'll have Striders FZ LLC, which will be taking care of the global side of the business. So whatever brands we are creating, this will be built through Striders FZ LLC, the Middle East subsidiary, and we will be doing basically an on-order kind of a model there, where when customers place orders, it will be supplied from the point of source to the customer directly. So again, in terms of our global expansions, the Striders FZLC will play a very important role. Now, talking about Striders Hub, that's the second subsidiary which we are currently made in the UAE for direct distribution in Middle East and the Middle Eastern regions. That will be a very critical part in terms of obviously expanding our stronger distribution presence in the Middle East. So there are two subsidiaries. One is FZ LLC to take care of the global side apart from the Middle East, and the Middle East subsidiary will be taking care of all the distribution needs in the Middle East region. Like currently, what we distribute in India, we do direct distribution to retailers and all of that. In a similar way, we will be going direct to retailers in the Middle Eastern region through Striders Hub. Both of these are very important vehicles for us, for the future growth. So it will play a very critical role.
Thank you. Next question, please. Mr. Vedant, how does the company source its products and how diversified are suppliers?
So currently we source our products from both India and China, particularly. In India, particularly after the toys were being banned to be imported from China, we have forged relationships with all the manufacturers whom we work with. Like for the plush side of the business, we have an exclusive arrangement with Teddy Toys, who's a Haldia based factory. We take currently all our capacities, of our requirement from that factory. Even all the mechanical plush is being made there, Pugs at Play, and it comes out of that factory. All the licensing plush is made there and comes out of that factory. So in India, particularly, we have tied up with different manufacturers who specialize in different categories, and we source its products accordingly. Globally, we work in a very similar way. We work with multiple factories in China as well. So a plush factory, we've identified multiple factories in China, be it plush, be it scooters, be it plastic toys, etc., etc. So we have diversified suppliers in each and every category, to source our products.
Thank you, sir. Next question, please. Mr. Akshay, what is your company's revenue growth perspective for FY26 and how do you plan to sustain momentum going forward?
Again, I think this is a forward-looking statement, which typically we should not be giving. But yes, uh, the kind of thing, the kind of subsidiaries what we are currently having in Middle East, global, and the India side of the business, where we plan to enter in the value segment as well, we are seeing positive growth perspectives for FY26.
Thank you for answering that, sir. Next, please. Ms. Shraddha, what are the key geographic markets contributing to revenue?
So
At the
currently,
moment,
go
yeah.
on, go on.
Yeah, at the moment for us, India as a market contributes close to 78% to our overall revenues, and Middle East and global side of the business contributes 22% of our revenue mix. And also from a geographical, like if I have to compare India as a market, again we are very well distributed across all the four regions, which is south, west, north, and east. Within that, West is the biggest revenue contributor, where 35 to 38% of the revenues comes from West. North contributes close to 25 to 26% of the overall revenues. South contributes 20%, and East will be close to around 5%.
Thank you, sir. Next question, please. Mr. Tripathi, how does the company manage logistics and supply chain risk?
So I think in terms of logistics, all our goods are insured during the supply whenever obviously it's been shipped out of China or it's being shipped out even locally. So basically, if you're talking about logistics and supply chain, if you're particularly talking about logistics from one place to another, yes, all our goods are insured whenever they are transported. In terms of supply chain risks, yes, currently we have a dual supply chain model where we obviously work with manufacturers in India as well as in China. So currently, in that ways, wherever we can, we try to obviously diversify our supply chain base.
Thank you, sir. Next question, please. Mr. Diljit, what competitive advantages differentiate Strider Impex from peers?
So Strider's Impex, when me and Mustafa basically, were thinking about this company, that's what we thought that, how will we differentiate from the current competition? So because I come from retail, Mustafa comes from distribution, we decided that in whichever category we get into, we will be a category solution provider, not a product provider. So that's the main differentiation. So whichever category we are present, we present the entire solution to the retailer, including the width and depth, including doing the price laddering, what kind of pricing works in that category, etc., etc. So the retailer finds a complete solution to us in that category, and it doesn't need to go anywhere else. Even in terms of licensing portfolios, whichever category we enter, we try to take multiple licenses in those categories so that we are able to dominate that category in a good way. So that's how we differentiate basically from the competition.
I think there's one more differentiator factor here. I think, like Kumar already mentioned, but I think I would want to emphasize on one more point. There are not many companies in India who are doing so many different kind of product categories across both license and own IP portfolio. The second thing, if you see, we have a entire experience in-house designing and product development team, which understands the licensing business and own IP business really well. So I think our speed to the market is also one of the big differentiator factor versus competition, because we have been in this space for more than 18, 20 years. The team also which we have on board is an experienced team, and majority of the key managerial people whom we have working with us, have been in the toys and consumer product space in the last 18 to 20 years. So that also gives us a big advantage versus our competitors.
Thank you, sir. Next question, please.
What proportion of
Anjali, what proportion of revenue comes from repeat customers?
I think almost all our revenues in India comes from repeat customers in the sense because India obviously we are very strong in distribution in the key retail side of the business as well as distribution side of the business. So whatever revenue is coming in right now is coming in from repeat customers. Though we keep on opening new customer base like a new quick commerce website, etc., etc. But large part of our revenue comes from repeat customers.
Thank you, sir. Next question, please. Mr. Anil, what are the key trends in the industry?
So in terms of trends, we would say basically, like toys is a category, particularly we as a company currently are not into trendy toys. Number one, basically, we are into core lines. Like we know that, the vanilla lines, like probably a plush, which will keep on going for years together. We know that our mechanical plush line, it will keep on, relating to the customer for years to come. So we are into categories where we know that, this is a trend-free kind of a category. In terms of trends, that there was a Labubu. There's a collectability trend currently which is going on in a huge way across the industry. There was Labubu which has come up. There are blind boxes which has come up. But these all are trends which keeps on coming and then suddenly vanishing. So currently as a company, we have not yet decided, to go into trend-based merchandise. And we right now currently, are focusing ourselves in terms of merchandise which we know that will surely be accepted across, larger timelines.
Thank you, sir. Next question, please. Mr. Sumit, the products of Pugs and Play, is it manufactured by you or from third party?
So the whole brand conceptualization and design has been done by us, but all the manufacturing is third party. We don't own any manufacturing.
Oh, thank you. Next question, please. Mr. Jogi, what entry barriers protect the company's market position?
So I think the biggest entry barrier probably we would say is getting into the complete solution providing kind of a thing, like and owning major licenses across various categories. That becomes the biggest barrier. So licensing is a is it's itself in a moat. In itself is a moat. Because when you take the license, we sign paper licenses. Both myself and Mustafa are product development guys. We have to do the hard work in terms of getting the entire factory identified, which is the right certification, getting the entire product designed, developed, getting it approved from the licensor, pitching it to the retailer, and then selling the lines, basically. So, this is a hard kind of a process which we have mastered over years. Again, as I said, Mustafa comes back from that very strong licensing expertise, and the team which is currently on board, who's a product and design team, they are masters of this. This is one of the barriers. The second is basically our understanding of the overall category. Both me and Mustafa come back from the toy category, with more than a couple of decades of experience each. The whole understanding about what to make, there's basically a lot of manufacturers are directly getting into distribution. They know how to make, but what we can say is basically over years of experience, we know what to make, at what price points to make, and what will tick in the market. So I think that we feel is kind of a good enough barrier to maintain a market position.
Thank you, sir. Next question, please. Mr. Rahul, what has driven revenue growth over the last 3 financial years?
I think we have expanded into different product categories, and also I think we have strengthened our license portfolio further. So I think that has basically, are the primary reasons for our revenue growth for the last 3 financial years.
Thank you, sir. Next question, please. Zachel, how strong is the company's cash flow generation?
So I think ours is a working capital heavy business right now. So yes, the cash flow generation is strong. We normally operate at 150 to 180 days working capital cycle currently. So yes, it's a working capital heavy business, but we know the kind of customers whom we are working with are strong and the payments are secure.
Thank you, sir. Next question, please. Mr. Hardeep, what working capital challenges does the company face?
So obviously, every time we would like to expand into India, we will need capital to expand. So that's where, in fact, one of the objects of the issue when you saw was raising funds to add working capital to enter more categories into the India distribution side of the business as well, and as well as Middle East side of the business. So yeah, wherever we are currently into distribution and we keep on entering new categories, we will need obviously working capital to grow at that pace after investing our own profits as well. So if we want to grow at that pace, we will be adding back our own profits. Plus, obviously, we'll need working capital to expand the business.
Thank you, sir. Next question, please. How sustainable are the current margins?
I think the margins are quite sustainable currently. Again, the the PAT margins, what we estimate is basically between, anywhere between 10 to 11% for the long term. So these are the kind of sustainable margins what we think we'll be able to achieve.
Thank you, sir. Next question, please. Mr. Lakshmikant, what are the key business risks and how do the company plan to overcome challenges presented by operating in premium product categories, especially licensed portfolio?
So I would say basically, the key risks are basically the licenses getting expired and then we'll have to renew the licenses. But the good part is that we sign paper licenses from all the licensors. We do the entire hard work of product development. We don't buy ready products from overseas countries. Like normally, what people do in Middle East is basically if they have the license of say a big studio, they will straight away go to an existing distributor in other regions and buy the product from them at an expensive price. From that kind of a customer, it becomes very difficult to retain the license because anybody can then obviously just pay kind of a higher mg and get the license transferred. For us, we do the hard work in terms of the entire product development, the price laddering, etc. And that's the hard part where licensors, for licensors also, it's very difficult for people to get people like us who develop the entire product line and then put it across in the market at the right price points to get the repeat orders. So that's how obviously we maintain our position in the licensing kind of a business. In terms of our own IPs, after careful study, we enter categories where we see the product gaps which were operating and provide an end-to-end solution in that category. So, like in mechanical plush, we have more than 40 plus SKUs in that range. It takes time, effort to develop those SKUs, to identify the factory, to make sure that the quality levels are top notch, etc. So again, these are some of the factors, what we normally operate with, to protect our business in the long term.
Thank you, sir. Next question, please. How will the fresh issue proceeds be utilized?
I
So
think
10 CR will be deployed. Mustafa, go on.
Yeah, I think so. Out of the fresh issue, I think 10 CR will be utilized towards the working capital for expanding the India side of the business. 4.5 CR will be invested in expanding the Strider's FZ LLC side of the business, which is the global side of the business, which we want to focus on. And 6.5 CR will be invested as working capital in the Strider's hub, which is a Middle East company which we have started to service all the retailers directly in the region out there.
And again, 3 CR will be used to pay off the loans, currently the NBFC loan, what we have.
Okay, thank you, sir. Next question, please. Mr. Jayesh, how will promoter shareholding change post issue?
I
So
think
we'll
we'll
be
see
holding,
close to
close to 69 point.
69.5%. Yeah,
Yes.
after the issue.
Yeah. Will
Okay.
still be the majority
Yeah.
holder in the business, close to around 70%. Yes.
Okay. Next question, please. Mr. Pavneet, ROCE has absolutely down. It was at 128% in FY23 and dropped to 58% in FY25 and now 25.98 in December. What is causing this massive deterioration in capital efficiency as you see?
So I think in the long term, what we see as the sustainable growth is between 28 and 30%. That is a sustainable growth because earlier when we entered into business, we first year we entered only with our own brand Pugs at Play. Obviously, we were creating it only against orders, supplying it, getting the payments. There was not much working capital required there. So that's why we were able to obviously sustain that kind of a growth when we started off. As we kept on expanding categories, as we kept on expanding the retail presence across different channels of business, obviously the turnaround kind of a thing, the working capital requirements increased, and that's when you saw deterioration of the capital efficiency. But again, the ROS, what we currently see is the kind of ROS which will be obviously sustainable in the business.
Thank you, sir. Next question, please. Mr. Pavneet, you are reporting good profit growth with PAT hitting 8.40 crore in FY25. However, your operating cash flow for 9 months ending December 2025 is negative 6.75 CR. So, why is the business burning so much cash?
We are also expanding into newer categories per se. Like we have entered into a few new categories after obviously first 6 months. We are paying advances to our what do you call manufacturers to develop more lines. We entered into Disney recently. We are buying fabrics for Disney, etc. So yes, I think we are getting ready for the next growth stage right now, and that's why you're seeing a negative cash flow in the business.
Okay, thank you, sir. Next question, please. Ms. Meenakshi, what is the minimum promoter contribution?
Sorry, what does that mean?
Ms. Meenakshi, could you please elaborate? Until then, can we have our next question, Mr. Sumit? So, does it mean that all of your products are manufactured from third party?
Yes.
Thank you. Next, please. Ms. Kalyani, how long is the promoter lock-in period?
I think you'll be able to, a merchant banker will be able to tell us better. We have no intention of obviously liquidating our stocks in the near term. We want to take this company to the main board. But yes, technically, I think Ashwin will be able to tell better.
So the lock-in period will be around 3 to 4 years. So as the promoters already mentioned that they have no plans of liquidating
But
more. And,
technically, I think technically we have to get back in terms of what is the
uh,
technical lock-in period. What is it? So you get back to them later on.
we'll
Is that
that
right?
we'll let you know later on, sir.
Yes.
Thank you. Next question, please. Mr. Raghav, what are the main objects
I
of
think
the
we have
issue?
answered this question. Mustafa has
Can
answered
we
this question.
can we have our next?
Um,
Mr. Balbir, is the company dependent on a limited number of suppliers?
so we prefer working with a set of suppliers and giving them good business. But at the end of the day, both me and Mustafa come back with a large supplier base. So we know when it's required to expand the capacity, or when the time comes, we'll be able to use other manufacturers as well to build scale across China and India both.
Thank you, sir. Next question, please. Mr. Bhaskar, is the business exposed to foreign exchange risk?
Yes, particularly in India, where we import almost 50% of our lines. If the fluctuations happen, it does impact the margins as well.
Thank you, sir. Next question, please. Are there any ESOPs issued by the company?
We have kept a 5% pool for our employees as of now for ESOPs.
Thank you. Next question, please. Mr. Pavneet, despite claiming an asset-light model, the current borrowings have increased from 3.92 CR in FY23 to 22.34 CR in December 2025. Why company is accumulating so much short-term debt so rapidly?
I think growth always requires capital in the sense for a business like us, which is into distribution directly, where our working capital cycles are high. When we enter into newer categories, when we enter into newer retailers, newer markets, obviously we will need more goods to buy. We will need more capital, to deploy in the stocks. So if even if you see the growth, what has been happening since FY23, to maintain that kind of a growth, we require that kind of a working capital. So yes, I think working capital is an important part of our growth story.
Thank you for answering that, sir. Next, please. So, Sudhir, are there any outstanding litigations against the company?
No,
Next question, please. Mr. Pavneet, you are raising 10 CR for domestic WC since inventory is at 17.37 crore and receivables at 21 crore. Isn't this 10 crore raise basically plugging the cash flow gap created by unsold stock and unpaid distribution?
No, I think the 10 CR additional what money we are raising for working capital is basically to plug in additional newer categories which we are not into, and it is not for plugging the gap between unsold stock and unpaid distribution. So I think the additional 10 CR working capital what we are taking is basically to fund the newer product categories which we are planning to enter in the new financial year.
Thank you, sir. Next question, please. Mr. Sumit, is OK Play the only listed peer of our company?
No, I
Sir, I
think in
think I
fact,
will.
I
Uh,
think just December, I think we had KV Toys, which is again in the toy space, which just got listed. So I
But
think,
during our DRHP time, the KV Toys was not listed. So
yeah.
since at that time only OK Play was listed, so we took them as the peer. But in December, as sir mentioned, KV Toys was listed.
Thank you, sir. Next question, please. Mr. Anil, as you said, you have diversified revenue base. Will you please bifurcate the revenue coming from different segments of your business?
Yeah, so currently the entire back to school space, which includes school bags, water bottle, lunch boxes, that contributes close to 45 to 46% to the overall revenues. I think mechanical plush, within the plush segment, there are two segments. One is mechanical plush and one is the non-mechanical plush segment. I think plush contributes at the moment close to around 32% to our overall revenues. And the balance comes from fashion accessories, role play, and mobile toys.
Thank you, sir. Next, please. Mr. Lakshmikant, your company seems to have focus on Middle East. How does this help in driving sales volume? What percentage of sales achieved from this region?
At the moment, currently, in the current revenue mix, like I said, that 22% is coming from the global side, which includes Middle East as well. If I further have to break that down, I would say close to around 15% would be coming from the Middle East side of the business. But going forward, we have started our own distribution company under the name Striders Hub, where we will be distributing the products directly to all the major retailers in the region. Again, if you see, India is a fragmented market. Cracking distribution here in India is relatively difficult, whereas Middle East is a much more simpler distribution market because you basically supply to 7 to 8 big format stores, and 85 to 90% of your market is covered out there. Also, Kumar comes from he has a great experience in the Middle East side of the market because he was a buyer at Landmark Group for almost 5 to 6 years. And retail is a small knit community, right? Majority of the buyers in Middle East across all the major stores are Indians. So again, they have been friends with Kumar for a really long time. So getting foothold into Middle East becomes relatively easier. And also, we are expecting our business revenues to double, just by going direct in the region. Also, it will give us a better margin as well. So I think going forward, Middle East will be an important market for us.
Thank you, sir. Next question, please. Mr. Tripathi, does the company face customer credit risk?
So at the moment in India, if you see a majority of the key retail players whom we are working with, all these are large format stores where you have VRFs in place, where the payment term, the credit period, everything is decided. And in the distribution side of the business, we usually work on PDCs from our distributors, which ranges between 45 days to 60 days in certain cases. So, and again, we have a sales team in India. We have been, since my past experience has been in the distribution side. So the set of customers what we have, are customers who usually pay on time and who follow a certain financial discipline. For the global side of the business, at the moment, whoever we are supplying stocks to in the global side of the business, we work on advances, and the balance payment is usually on BL copies.
Thank you, sir. Next question, please. Mr. Manan, what percentage of your goods is imported from China?
Currently, it's 50-50. 50% of the goods are imported from China, and 50% are locally produced in India.
Thank you. Next question, please. Ms. Shraddha, looking forward to the IPO.
Thank you. I think we are also looking forward to a successful IPO.
Thank you, guys. Thank you so much.
Thank you.
I think we have covered majority of the questions.
Yeah.
So thank you, Mr. Sir. Thank you, Kumar Shri sir. Thank you, Mr. Ashwin. Thank you and
Thank,
all the best for the IPO.
thank you, Tejas.
Thank
Thank
you
you,
so
Ashwin.
much. Yeah.
Thank you. Thank you all.
Thank you.